taken my class and don't want to, if you want to review this, you don't want to go through the whole Zoom call and everything else. Okay. And so I'm making it public to advertise other things. And now I'm going to move to independent power producers, and we'll do a little case study and talk about availability projects and projects that have capacity payments. Okay. And, you know, maybe this sounds old fashioned now because it's not renewable energy and all that. Here's a power plant in Ghana, combined cycle plant uh, with some steam recovery and some turbines and everything else. Okay. And I think it's really, I like to start with these. I'm not going to say it's really good. I like to start with this because it forces you to, first of all, deal with the history of project finance. I don't know when the first project finance was. There's an argument that the Panama Canal, in the when the French financed this, it was private. And when the French financed this, it had some very similar characteristics to project finance. And then, uh, uh, but the history, a lot of the history and a lot of the principles for public-private partnerships and other things really come from these electricity projects. And then we'll go through some risk allocation and we'll introduce this whole business of availability, which a project that's dispatchable in electricity is typically an availability project where you get penalized for not being available, but you don't get penalized if the government or the off-taker or whoever uses your stuff does not want to take the power. So there's a big difference between getting paid just if you're available versus getting paid if you're actually producing. This is this whole business of take and pay or take or pay. And then we'll go through some details of the power purchase contracts. Uh, and those have incentives and see how you can structure these, and if they're structured incorrectly, what the problems were. And we'll go through some case studies. So IPP is independent power producer. It could be a merchant power plant that buys from the market, electric purchase power agreement, a power purchase agreement, whatever is a contract between an off-taker and this IPP. Energy conversion agreement is just a different, really, or a tolling agreement. It's a different kind of purchase power agreement. Very, very similar, really. A special purpose vehicle, you remember that's the thing inside. We've already dealt with that. We'll have a capacity charge, which is not output dependent. That capacity charge is a fixed charge per month. The capacity price can be something in a merchant market, a multi-party tariff. That's when you have energy prices and energy and capacity charges and so forth. And we'll talk about dispatching, capacity factor, load factor, try to distinguish that. And that's enough. And then, people are asking me, oh, what about all these acronyms? Don't you have to worry about what all these acronyms are? I say, stop it. Rambo. Where's Rambo? Brought. That's a sausage. But that's build, rehabilitate, operate, and then transfer. Build, transfer, and operate. Build, operate, own. This one you transfer back to the government. This one you never transfer it back to the government. Build, operate, transfer. Rehabilitate, operate, maintain. Rehabilitate, operate, lease. Okay, make up as much of these as you want. Now, I'm going to begin with a tiny, 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 tiny Excel exercise. This is from the Philippines, and they had 16 contracts that were bidded, 19 negotiated. Typically, look at the difference between these ones where you transferred to the government, these ones where you continue to own. There were more that you transferred than you owned. When you transferred it back to the government, very often the government gave you a guarantee on top of the contract that was signed. So, uh, just to talk about these different structures, because some people have questions about this. I have a little example. Let's say you want a fixed cost EPC contract because the government doesn't want to take the risk. We're going to talk about that a lot later on. So the cost overrun is accepted by the contract. And you don't want to start taking cost plus kind of risk for the operation and maintenance. You want a contract with really good incentives to operate this thing really, really well, and you want to write that all in a contract. And now, let's say the cost of financing is really low for the government, much less than it would be for a private contractor. Why don't you make a BTO? And in Mexico, they kind of did this. Get these people to compete for an EPC contract and for a operation and maintenance contract. You could do that. Maybe the issue there is how to attract investors. And then I'm going to deal with some philosophy. And the philosophy is around the following. If you have an operation and maintenance contract, if it was just a cost plus contract, how much risk premium should you add? Should you add anything? Because if it's just a cost plus contract, you make a little bit of money by you take your employees, you add a margin to them, and they say, go work. And finding the risk is difficult. If it's a contract with a whole lot of incentives and liquidated damages, which we'll get into, and maybe we add a risk premium. And then you get into something more complicated. Should we add a bigger risk premium for a country in Africa, Liberia, than you would add for a country in Nigeria? I mean, in Germany, sorry, a country in Europe. And the question is, really? Would you? If the off-taker doesn't pay, you can walk away from this contract. Maybe there a little bit of cost to that. But why? And you can say, it's more difficult to do business in Liberia. Well, you should add that into your base kind of fee. Putting just an arbitrary risk premium for a country is a very questionable thing to do, in my opinion, which my opinion doesn't mean anything, and my opinion is a tiny minority in the whole world. But I hope that you would start to think about these things. So if you have a BOT, then you have you get the benefit of the fixed price contract. I should have moved BTO to the top, shouldn't I have? And you provide all the incentives, and uh, uh, it does require contracts, and maybe if you got good contracts, you can get close to the government financing. But maybe the government is really expensive to finance this. Maybe they don't want to. BOO, if there is a BOT, you have to leave this equipment in really good condition before you transfer it. So it's not a big deal, BOO, you just own it. Now, what I said here is that, okay, and then I have a little more discussion of this, that the government can provide a guarantee. You have to make sure the equipment can be transferred very well, and all of those things. Let's deal now, and here's what I started to do. I did not make a complicated, we have a very basic case. Now, even for this basic case, I put some inputs, Egyptian pounds, fine, and I put some premium that you might charge for this contract. And then I put in a very simple way a 100-year case. maybe I should have made it longer. Uh, I've got to, you know, why don't we make it longer? Now, I'm I'm almost doing what I'm afraid to do. Look at me. I can't say things without stuttering a little bit. Alt EIS, and let's go to 300 years. Okay, and let's copy this across. Okay, now even with something as basic as this, I suggest you use the generic macros. So when I did this, I've given people a file and suggest they use this, and I don't think they were very happy or impressed with all of this. And let's put even 11. Let's make a little top of this with 11 things at the top. Okay. Okay. And so we have, and I'm going to make this, how about a little bit smaller? And then let's take our grid lines out because this guy named Oliver said I should take my grid lines out. So we have this one. And now what I'm going to do in this very beginning case is just show you I have an acceptable return and I have some revenues. And we don't even have to worry about the revenues where they come from. Right now, we could go up to 300 years for our contract, our own, if we BOO. But if we transfer it, we only get it for the contract period. How much more valuable is it to get this project for a long period or a short period? Now, let me do something really bad. Let's say we have 220 as our revenues, and they don't even grow, okay? And we put a NPV, and I don't know where I came up with this target return, but this target return is the cost of capital, and that came from up here. Let's say that all we really need is 6%, okay? Now, if what I did up here is made a simple little thing, again, the Excel doesn't matter whatsoever. The Excel doesn't matter whatsoever. And when we do this Excel, I limited the contract to 20 years, and this IRR was, what did I put, 220? With those extra zeros. So we get a 17% IRR, enormous IRR. What happens if we make our contract period, instead of this, we make our contract, I don't like this. Excuse me. Okay, because I want to see the inputs. Okay, I want to see what's our input. What happens if we make our contract period, instead of 20 years, we make it 10 years? If it's only 10 years, our IRR goes down a lot. Our NPV goes down a lot. Now let's make it 20 years. So we have a BOT for 20 years. Our IRR is 17%. Our NPV is 12. Now, let's say we own the project and we get an extra 10 years of life for the same rate. Our IRR did go up a little bit. It went up to 18, and what was our NPV? 20. The IRR went from 17, and you know what I'm going to do? Let's just copy this for a minute. So this was our 20 years. All right, let's do this better. Let's make a data table. Let's put 20 years and 30 years, and let's start with 10. 10 years, 20 years, 30 years, 100 years, 200 years. I'm obviously doing this in very extreme case, and let's start with 150 and then go to 200 and go to 250. So this is going to give us a really, really high IRR and these ones less. And let's make two of these things. And what I need to do is, so when I have a class like this, we do some very basic Excel, just enough so you can see some of the key real principles here. And let's put the IRR here. And this is such a basic point about IRRs. If the IRR is really high, I'm trying to show you that if the IRR is really, really high, let's make a data table here. I'm afraid that I might have some other things open. And when we make a data table, we're going to change the row input, and we're going to change the contract period. Then we put this in, and it gives us the same result. So we go to our formulas and change it to automatic. So here, let's look at this. When you've got a really, really high IRR, and this is just pure math, and the IRR is a good thing to look at. I'm not arguing against the IRR. You get a very, very small difference when you start to get between 10 and 20, okay? Maybe I should have put 15 here like we did before, and then maybe this should have been 20, and maybe this should have been 40, 30, and then this should have been 200. That's fine, okay? When the IRR is smaller, it seems to make more of a difference. Now, this is not real. This is a problem. And what I am struggling to do, what I am struggling to do in my life is to make this thing more real. This is because the IRR has an assumed reinvestment rate. Okay, it assumes that you reinvest, and it's essentially like discounting at a really, really high rate. That's why the difference between these ones is so small in this case and so big in this case. When we put the NPV and when we use a reasonably low discount rate in the NPV and we do the same data table, okay, and I'm getting a little more relaxed. Of course, if you have questions about a data table, don't look in this video, look in another one, and then I put the contract period in. And then now when we look at the NPV, we get bigger differences. This percent, let's put the percent versus the year 15. This one, this percent increase, okay, is, oh, it's a little bit, 4, 2 thing, but this one, if we take this one and divide it by this one, 15, right? I think did I press the F4 here? Sorry about that. See, I'm hurrying a little bit. Okay. And I need to really relax on this stuff because I get nervous about how long these videos are going to be, and I got to stop that. And then we can see, oh my gosh, this is, well, it's interesting that the 30 versus 200 didn't increase very much. And this one, did I not press the F4? Okay, excuse me for that. Okay. So this one, we got a little percent difference. This one you get, you get, is that right? Oh, where did I put the -1? Excuse me, idiot. So this one you get 34 difference, this one you get 4. How much value do you really get from the not having to transfer? And sometimes I think people use these IRRs, and when they use the IRRs, please, 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 I'm not advocating NPV. NPV is, for me, it's just a number, doesn't mean anything. And maybe I am half, a quarter, a tenth advocating for that, okay? But you can see there's a real problem with the IRR when we're evaluating the BOT and the BOO. So what I do in this is I we'll use this very simple example to go through some other things. Now, we defined what an IPP is. Then I go through different models. And usually I skip through these, but for once, maybe I'm not. The question is, the first question is, what's the state ownership model? And that comes into the question of PPPs for hospitals and prisons and schools and libraries and everything else. Is it better to have a state-owned enterprise or a private enterprise? Of course, everybody from the private side will say it's always, always, always better to have it private because you'll operate it better and everything else. But you remember, electricity is always very, very capital intensive. Is always political. It's always capital intensive. And sometimes these privatization systems have been disasters. We can look at, I think Jamaica might be a really good example. They privatized the distribution of electricity system in Jamaica, expecting the losses to go way down, both technical and non-technical. It went up instead. It was a disaster. Okay, here's where I remember it came from. There were these nuclear plants being built, and you had cost overruns on these nuclear plants all the time, and then the cost came going up, and then the state owned, or really it could be the regulated utilities just put their rates up, and it caused these wonderful little I remember a cartoon said, oh, we're not going to get killed by the nuclear radiation, we're going to get killed by our electric bill. You used to be able to, and I can't find it in the EIA website anymore, you used to be able to get this wonderful database, must be available, of all these countries, any country, and you could get their capacity and their generation. In Nigeria, there's always been a lack of generation. So the other question is, why these state-owned plants were running at 25-30% when you needed all the power, and then they got up to a miserable 45% when they put in a couple new plants. It's still horrible. Do we need to give the private people an incentive to get their availability up? And here's what happened in Argentina, where the unavailability, that's kind of backwards, went way down afterwards. And this is a silly thing from World Bank, who knows? Okay. And then we can talk about the regulated power systems, and I suppose you can put incentives in some of these regulated things, but it's the same issue. We can also talk about this is the electric power. It's a kind of cool graph. I wonder if I could get it. I wonder if I could get this updated. But this shows you the gigantic amount of merchant capacity that was put into service, okay? And that's this issue of a full merchant system. Maybe a merchant system is good or bad, and I go through this California crisis and the fact that games were played, and this is the outages that were reported that probably weren't very real in this system. Okay. So then now we're finally to the what you'd call a single buyer system. So don't get impressed. Oh God, when I first started this, what's a single buyer system? What does that mean? It just means you have a PPA and one entity buys this. In Nigeria, that one entity would be NBET, the Nigeria Bulk Electricity Trader. Okay. And the problem, the issue, of course, the real issue, and I'm not getting into merchant power now, right yet. The real issue, and it's a fascinating issue, is the government still, or the single buyer, decides how much capacity and what capacity mix will be. And it even decides how you'll dispatch that. And then you can argue for merchant power that, no, we'd like the private companies to decide how much to build and take the risks of the errors in estimating demand and errors in estimating what's the right mix of capacity and all that. Here's, for me, I wish I could really update this on, no, I'll do this. If you get my disk, okay, and you go to the courses, and then I put this chapter 5 together. And in chapter 5, I've got some stuff on conventional electricity, and one of this stuff it says cost of service. So it goes through kind of some issues with how to measure different distribution, generation, and all that. And it also has some Nigeria availability analysis where I tried to take this thing called the daily broadcast report, which is really a fascinating little report made by the transmission company, and it shows how much. I think I've got to stop. I've got to pause and privatized with a PPA. Now the PPA was never paid. That's another issue. But when it was privatized, the production went down. Well, the production went down because they were fixing the plant. They were doing some real maintenance. And then the interesting part, I guess, it went down here. And then it went back up. And it continued to go up. Now, I wish I could get a hold of all these updated things where you can go through each plant in Nigeria and you see how much production is lost due to gas constraints. Should that be, where should that risk be placed on the IP investor or the off-taker? And then there's some transmission line constraints. Who should bear that risk? And then finally, there are even now more and more distribution constraints. These reports, you can just put these together and it has it hour by hour. I love them. Okay, so those are some of the benefits. Let's look at some of the problems. Here's the problem, and again, this argues really more for almost a merchant idea. Here's some power in Asia. Unfortunately, I can't find this on the EIA website anymore. I loved it. Go to each country, get the get the loads and for the country and the generation from different plants. And here was the projection for the Philippines. Here's what actually happened, and this is a better graph really of it that I found from the Department of Energy there. And so they had entered into a big, I forgot when they started, IPP program. Okay, and I suppose this is the oh shoot, this is the projected demand. This is the capacity, but this is the capacity plus all the contracts that were signed. So this is the real one. Okay, this must be National Philip. I don't know what it is. And then you can see what happened. They contracted for all of this capacity, so much more than they needed. And of course, since they're paying fixed capacity payments. They're paying fixed capacity payments. That means that no matter how much is produced, and obviously there was a gigantic amount of idle capacity with a reserve margin of 155%. There was an enormous, very low capacity factors, which didn't matter to the off-takers. In fact, they might have liked them. And so the Philippines had the highest rate in the region. This doesn't include some other countries, obviously. It just comes from Wikipedia. Okay, so now we're going to talk about and remember, I'm emphasizing this over and over and over again that this discussion of risk allocation does not only apply to electricity plants. It's just as much to our classic kind of PPPs. Okay, so you can think of now uncontrollable risks, and think maybe that fuel inflation is an uncontrollable risk. If we put this fuel risk on investors, number one, they're going to make sure they've got a very conservative and high kind of fuel price forecast. But number two, if they have to take that risk and you just fix the fuel price, you're going to you're going to end up, they're going to demand a much higher IRR. Okay, and I suggest, and so this is an example. Okay, so let's say we impose the fuel price risks on them. The actual fuel, here's the forecast that EIA made. always dramatically lower until they were dramatically higher, and I just kind of put the new forecast each time. I haven't bothered updating this. Maybe it's okay, but it's pretty obvious that it's difficult to forecast. And if you took that risk, if you took that fuel price risk, you would have to be very, very careful. You'd have to put a high. I'm repeating myself, so I'll stop. Okay, now work through on another video. And this is extremely upsetting that I did not uh, uh, save this from the last time. Okay, but the only point I want to show you is this business. Maybe I'll have to do this just a minute. Okay. Sometimes it goes to another page like that you don't care about. The right now I have an IRR of 15%. Let's put 150 in. Okay, that's a much more reasonable kind of. We get a project IRR that's going to lead to a much, much higher equity IRR. All right. Now, the if number one, you might add a lot of a higher fuel forecast, but if you impose this risk on the investor, and let's say as a government, you think no matter what, if it's going to be government owned or private, we're going to build some combined cycle plants. And all I want to do is get the cheapest price for my consumers. And if you have to, of course, charge a 200, if they need a 15% IRR, you've got to increase at least the capacity portion of that price a lot. Okay, if it's something like solar, that's really dramatic. And what do you get? The big issue is what do you get for uh, uh, for allocating risk that cannot be allocated? Basically, you're paying a lot more for for the project, and at the end of the day, I don't know. This argument isn't that well developed, but you're going to have to pay for that risk one way or another anyway. Uh, uh, if you're the government, or you're going to have to pay the same kind of expected price, and all you're going to do is increase the price without getting anything. If you think about it, if you can get the parties, the private party, to take the risks that they can control, and of course they can pass it off to the EPC contractor and O&M contractor. We're not talking about who ultimately takes the risk. If you can pass it off, then you can uh, uh, if they have a control of the risk, they can do it. That has much less to do with finance or economics or anything else, much more to do with human behavior or something like that. All right. Now, if you're allocating risks, that can be controlled, here is the big deal. That the penalties and the bonuses, whether it's a penalty for delay, whether it's a penalty for not having availability, the plant having availability, whether it's a penalty for having the plant not operate efficiently, whether it's that's about all I can think of right now in a a renewable project. Maybe it's a penalty for not having as much output as you promised. All of those kind of things all those penalties or bonuses should reflect the off-taker costs, not the costs of the people building the plant. And if you do that right, if you set the off-taker costs, if you over penalize or under penalize, you're going to get the wrong incentives. When it comes out of my mouth, it sounds pretty obvious. Why did it take me so long to kind of figure this out? I have a example of a lighting in a hospital. Let's talk about lighting in a hospital. And let's say that you set an enormous penalty, and that penalty is so high that you're going to have somebody standing next to the lights. You're going to have standing next to the lights with a big bag, a sack full of extra bulbs. Because if it goes out, my gosh, it's going to be a high penalty. We just penalized it too much. And how inefficient is that? Then people will have to bid more for the project, the price will be high, and you'll get nothing for that. On the other hand, let's say it's a operating room, and the lights suddenly blow up and go out in an operating room, and you don't have any penalty at all for that, and uh, 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 nobody checks the lights and nobody does anything about it, and so the doctors are operating in the dark. You can't have that in that. That's the issue of the penalty being so really small. I have another one. This is my example of an electricity plant in one in for a chemical plant in Saudi Arabia. It's a real example where the plant operated at a low availability, and the whole chemical plant had to go down because there wasn't enough transmission capacity. In that case, the best solution would have been to put a really high penalty and make sure that maybe the best solution would have been to build smaller units. And when smaller, you can do a little Monte Carlo that I used to do to demonstrate with the smaller units you have a lower, higher availability because and maybe you have a whole extra plant. Okay, but if it's in Nigeria and everybody has a generator in their home anyway, and if you go out, maybe you can't even get the plant to the distribution, the thing we just talked about, the system. The costs aren't so high. You should put a much higher penalty, of course, in the first one than the second one. So then we can go through all of these things, and these are pretty obvious. I used to think I'm so cool by doing this, and now I'm thinking, oh God. The plant cost and construction. You want the cost overrun to be taken by the investor, and as well as the delay, as well as the quality of the construction. The efficiency of the plant. You want that efficiency. And the way you measure efficiency for what it's worth in electricity, you do it backwards. Efficiency is normally output divided by input. This time they talk about the input in terms of the quantity of fuel, energy value of the fuel actually, divided by the electricity that goes out. That's a heat rate. That the investor can control. That's pretty obvious. So the fuel price, you could debate a little bit about this, but if there's a worldwide index, you let the fuel price be taken by the off taker because you don't want maybe the investor can go out and hedge fuel prices or whatever. Maybe they can do that better than somebody else. Well, the government can do that itself. And if they start doing that, you can distort the dispatch. You can, all sorts of problems can arise. And then we get the big one. This is the really big one. This is what defines availability project compared to a output project. I'm not talking about renewable. I got in trouble once. Some guy yelled at me, renewable, you're confusing renewable and dispatch. Solar and wind, you can't control the dispatch. Somebody upstairs controls how much sunlight there's going to be. Somebody controls how much wind there's going to be. Not the off taker. But if it's dispatchable and you think about a knob that you can control, the off taker tells you, turn this plant off in the middle of the night, and then turn it on in the summer. Run it at full capacity in the summer, only half capacity in the winter. The off taker tells you how much to run. And if the off taker does that, it's pretty obvious, isn't it, that you do not want to take the risk of the capacity factor, because remember the Philippines, what if the off-taker starts building way too much capacity or different kinds of capacity? Sometimes your output or your capacity factor will change in terms of variable O&M. But availability is another matter. If the plant is not available, just like our light bulbs, if the plant is not available, you need a penalty. If it is available, no, okay. And now let's go to variable and fixed O&M. Well, that's again, it's very, very similar to the plant cost. You agree up front how much you're going to pay in operating costs, and you do not get to go and say, sorry, my expenses went up, with one exception, a gigantic exception. If there's an exchange rate and or an inflation rate, well, that's two, but whatever. You don't control the macroeconomic things, but you do control the pure expense. And you don't get to add things just because you're crying and you estimated things wrong. Now, what all of that means is what that's once you here's I can't get my words out again. What that means is when you read the contracts now and you see an inflation index in fixed O&M expense, you should say, I understand what that is now. Okay, this is why they're doing it. You don't want the investor to start kicking up the IRR because it's taking inflation expense. We got to be really careful, by the way, with inflation expense. And this is another example of probably should have put this in the next section, but I'll leave it here for just now. This is again a discussion about availability versus output projects. If you think of a hospital or a prison, let's think of a prison, and you're privately financing this prison, and if you would make it an output-based project, that means that the more prisoners you have, the higher your profit. Not the higher your cost, the higher your profit. Similarly with hospitals. And you can't control either the number of criminals or the number of patients. If that was the case, if your profit depended on how many criminals or prisoners you had in the project, then oh my gosh, you'd encourage crime or you'd encourage sickness. This is a bad subject for right now, and it's not happening with whatever the pandemic and all that stuff. But the way you want to structure these contracts is to make sure people build the stuff efficiently, maintain it efficiently. That's maybe too obvious, and I'll skip this because I'm going through it too much. And then you can get into really tricky little problems. What happens in Nigeria to this issue with the gas? Remember, there was this outage due to gas constraints. Somebody's blowing up the pipeline. Let's just be direct about this stuff. Sometimes not the case. Sometimes it's because you don't pay for the gas. But somebody's blowing up the pipeline, and you say, I can't control that risk. What are you, crazy? But just a minute. You could build the pipeline a little bit deeper, or you could build your power plant right next to the gas field, so you don't need a power plant. Okay. In that case, which should it be allocated to the investor or the off-taker? These kind of questions are really interesting. They're not exactly uh, 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 straightforward sometimes. And let's now go to the how these things really work. Okay, the first issue that I've gone through again and again and again is how do we structure the contracts so we allocate the risks appropriately. And maybe this is why I got this negative downward thinking, why are people giving me these dislikes? Well, whatever, who cares? But maybe they didn't like my marriage example. But here was this one. Before the financial close, you're taking all the risk. At the financial close, you sign the contracts, agree to the maintenance, agree to the construction cost. And then if something happens here or here or here, you can't go back and beg for things. You sign the contracts at the financial close or before the financial close, before that you actually make the expenditures. And that's how the risk is really allocated. So the first issue is that you sign the contract, the big contract with the off-taker before you sign that before the financial before you start constructing. And then, in order to structure these things, you need to cover some variable costs and some fixed costs. There are the fuel you buy is that depends on the output. Now, you can make a little profit. This isn't all perfect. You're not supposed to actually necessarily recover the fuel one on one. You can fiddle around with these things. But the capacity charge should cover some cost, and then some costs vary with output. And without changing your profit, that's the theory, you should get to recover those costs. Of course, you can put little profit in there, but you might lose the bid then. That's the idea. So you have a capacity payment that doesn't vary with output, that has unavailability penalties in there, and can be often just nominally fixed, which means you're taking inflation risk as an equity holder. Because if for example, it's indexed to the USD, which can occur, sometimes cannot, sometimes it's indexed to the local currency, it could be to euros, whatever. If it is, and there's suddenly a very big inflation in the US, and you get paid the same amount in USD, the equity holders normally would want to get a higher IRR. When there's more inflation, they don't get that. So in actual, if you really, really think hard about this, when these things are indexed to inflation, the capacity payments are indexed and they go up with inflation, it looks like you're taking inflation risk. The bank is taking inflation risk. The equity holder is taking less. Fixed O&M charges, again, that's the cost, of whatever, somebody, security guards or accounting or some kinds of insurance. And then that just is fixed, but that goes up with inflation, and it could go up with local inflation or a common currency inflation. And the energy charge is a little bit more complicated because the efficiency of the plant is part of how much you're going to pay for fuel. If you're a lot less efficient, you've got to pay a lot more for the fuel. So you've got to split this into the efficiency and the real fuel cost, and then the variable O&M. Well, so that's a four-part tariff, and here's an example of a four-part tariff. It's not a great one because this should be really kilowatt per month. This should be just flat, and I guess this is based on the available kilowatt hours, and then I think component B was the fixed O&M, C was the fuel price, D was the variable O&M, and then they had, I think, some startup costs. Okay, and here's if you line up these charges against a profit and loss statement, you start kind of at the bottom, and you say, okay, what the EBITDA, here's a profit and loss. We've got stuff above EBITDA, below EBITDA, all the stuff below EBITDA, the equity return or the net income, the interest, taxes, depreciation, that's all covered by the capacity charge. And then you step upwards and say, okay, then we have some fixed and variable O&M and fuel expense. That's all covered by the other charges. So really, you think about capacity charges covering the fixed O&M. Okay, and enough of that. And now I'm going to go to Christopher Columbus. I'm going to talk about a little case study, one of my favorites. This is the Lagos Barge project, and I can't remember because I've made this before, but my friend from Venezuela said when they signed their PPA contracts, it was like Columbus and the original people, the natives, and they said, I'll take your gold and whatever, your slaves, oof, he was mean, and you give me whatever, I'll give you a little trinket here and there. And that was what signing some of these original contracts were. And this is so beautiful. So the Stanford Business School, the Graduate School of Business, they talked about their social responsibility and how this barge, this is not the barge, it's a picture of a different barge with an electricity plant on it, that how wonderful AES was, and they had just bought the plant from Enron, I think. Does it even say that they had just bought it from Enron? I don't know. Enron had developed the plant. Now, we've got to be careful. It was a 270 megawatt plant. They bought it from Enron for this. The first thing you do ever with an electricity plant is you divide that by that and see how much it cost, and that's a pretty high cost, almost 1,000. That's a ridiculous cost. At that time, costs even for a new combustion turbine were somewhere from 250 to 400, but this was a used one from the Philippines. Probably cost 100, okay, per kilowatt. And you just remember 100 per kilowatt. Remember that, or 200 or even 400, whatever. And then you can look at other plants, other natural gas plants in I don't know, in Egypt at the time were 400. These could have been combined cycle plants and whatever. I put some other plants here as well. Try to benchmark these. This is my theme. I when I go through this I go crazy. And then you look at this 200-page PPA agreement. You look for the capacity charge, and in the capacity charge, you find 19.35 per kilowatt month. And then you go to your calculator and you say, what's 19.35? What should I multiply that? How about 12? And I got 232 as my capacity payment per month. 232. The cost of this project was probably less. They probably paid off this project in 1 year. You don't have to do much of an IRR analysis or anything else. I know there could be a little fixed O&M, okay, whatever. But you don't have to do much analysis to get to say, oh my gosh, okay. And then let's continue. So that was my first example of a PPA agreement. You can look at all the other provisions and everything else. For me, that's the first thing I looked for. Okay, here's another example of a capacity payment, and it has some indexing. And all I want to show you here is don't get intimidated by this. I used to hate these formulas. I don't know if I love Excel or hate it, whatever. Some people hate the models, some people hate the formulas, some people hate it all. But when they have something like this would be something where you get a CCR I guess that's in USD, or this might be even it might be in the local currency. I'm not sure, but the reason I'm hesitating is because you take the exchange rate and you divide it by a base exchange rate, and you that's how you do your indexing to USD to take the local inflation out. Now, there's a big theory behind this one. A big theory. You can say, oh no, the people are paying in local currency. But if you believe in PPPs, not public-private partnership, purchasing power parity, you believe in that one, then you say, okay, no. I the reason the exchange rate is going to really change is because of the inflation. And if there's a whole bunch of local inflation, that's okay, because everything's going to inflate. The price of beer and everything else is going to go up. So I can pay more for electricity if I put it in back to USD. There's some more inflation examples. And then you have in the PPA contract, in the contract with the off-taker, you have all these provisions for liquidated damages or some. And this is a provision for liquidated damage that's due to a delay. And does it say somewhere here that somewhere it usually says that this liquidated damages, even it says that they reflect the cost to the off-taker, because legally that's what they're supposed to do. It's another example. Okay, so we've gone through some examples again of some of these contracts. Here's the contract with our Christopher Columbus project with the Lagos barge, where they actually had you adjust the capacity charge. If it's late, you get a higher charge because you take the base rate and the current rate and you get to push that up. And this is the the final capacity charge, and you look through some of those. Now, let's go to the next thing, which is the availability target. And again, for me, the best way, it's not the best way, but one stupid way to do this is to think about your sick days. And I think there's a limit you have on sick days. I'm not sure how it all works. And you can think of the plant being out for maintenance. And if you have a normal kind of, you have a limit, you have a normal kind of availability for your job. If you have too many sick days, I think you might not get paid for it sometimes. Okay, and if you have the sick days, they don't carry over from one year to the next year. So and you have to have a time element when you measure the outages and how much time you're down, and then the penalty will have to be after a certain amount of time. This is the scheduled hours, and this is the some kind of weighted average of the availability, and so they're computing the availability target. And then once you compute this availability target in some kind of time frame, then you have the penalties. And if they're you oops let's go to the next one. Let's go to this one. If you're above a certain if you're unavailable by a certain amount, okay, you get a deduction factor, and this deduction factor can increase. In this case, I'm not sure exactly what the 1.5 means, but you can assess how much risk you have. So the risks now are not that we can't produce electricity because we pay for the risks are associated with availability. And this was kind of interesting because in the summer period, you had a lot more in the summer period, the cost to the off-taker, because the loads were so much higher, was much more. In the winter period, you just kind of get a one-for-one penalty. In this case, if you're really unavailable, you get a much higher penalty. This forces you to keep your plant operating in the summertime, and you don't give quite as much of a, you don't care quite as much in the wintertime. But it really, really illustrates the off-taker cost. Okay, and you could even go through kind of what the marginal cost is. I love to do that kind of thing where you see here's the marginal cost of the system, here's the cost if we're unavailable, and all of that. Now, in terms of the energy charges, the little confusing thing is that we have a fuel charge, and this fuel charge is a cost per megawatt hour, kilowatt hour, gigawatt, megawatt hour. How's that? And this should have said euro per megawatt hour. I'm sorry about that. And well, the actual amount you get is the somewhere it says, I hope, energy charge per unit. Fuel cost is outside your control, efficiency is inside your control. We have two parts of this. One is the fuel cost per energy unit, could be BTU, MMBTU, meters cubed, anything like that. Here's the cost. You cannot control this, but the heat rate, that's the efficiency. You can control that. So you promise to make a heat rate, you plug in a fuel price, you multiply it by how much you produce, and that's how much you get paid for the energy. Okay, so they're also fixed and variable O&M parts. The variable depends on how much energy you produce, and it can have the same sort of target energy in there. Here's an example, a little bit of what this heat rate really does. You can measure the input in all sorts of different ways. Then you've got a power plant, you get the output. This is the input divided by the output, not the output divided by the input. Okay. Now you could say, I want to contract for fuel, but typically you get this. Let's skip over this one, and this is how you could set the fuel price based on an index rather than the actual fuel price. so that you're encouraging people. If you can do better than the index, you get to keep it. If you're doing worse than the index, you don't get to keep it. Now, I'm going to try to go through this and illustrate these penalties, illustrate how these penalties can hurt you. And as an evaluator of project finance or an investor, there are a couple of themes here. This is the availability penalty. The bottom line is I computed a gas and a coal plant, and I said, well, the unavailability hurts the coal plant more than the gas plant. You have more EBITDA, okay, and then I put that we have a target availability. That's the amount we're supposed to reach. 95 would be too high for a coal plant, probably, whatever, but we miss it by 10%. Now, once you miss the availability target, then I can put the hours and all that, but you get a penalty. You get a penalty, and the penalty is off of the capacity revenues. Now, typically a coal plant will cost, coal plants might be, I'm sounding obsolete now, but this is a more capital intensive plant, whatever. They cost more than the gas plant, so you have a higher capacity price to start with, and simply you have a higher capacity price to start with, and then the penalty hurts more in absolute terms by a big margin. And why did I have it hurt more in relative terms? I can't remember, but whatever. Sorry. I guess you're operating less, so you're something. That was horrible. I'm going to keep going anyway. If this is the more interesting one, this is the heat rate penalty. And let's say we have a capacity factor that's really high for the gas and the oil plant. Now, if this capacity factor is less, which we're not supposed to take output risk, but we really do, we really, really do, because we have a target heat rate and an actual heat rate here. And the actual heat rate is higher than the target heat rate. And if that's the case, the difference between the actual target and the target heat rate, this you pay the fuel based on the actual heat rate. So this is how much you pay. You get paid in the price from the target heat rate, and you can see the difference. And if the gas price is really high compared to the coal price, this penalty is magnified by the gas price, and this can kill you in terms of the EBITDA. This can kill you, whereas the coal plant, because we had a much lower price, was much less. Now, if you were operating only at 20% capacity factor, then the generation would be much less, and the cost would be much less, and your penalty would be much less. So you can see that indirectly you're taking capacity factor risk, but it's very much of an indirect thing. That's how the risks come into play for a project with a capacity payment or availability payment, but some penalties. Okay. Here, then the heat rate, of course, I said, of course, again, I didn't mean to. The heat rate gets much more complicated because when we're establishing a target heat rate, it's not a fixed target, it's a moving target. The target heat rate depends on the temperature. So we might want to, if the temperature is much hotter, the plants are less efficient, especially a gas plant, and you may allow the heat rate to be higher. If the off-taker tells you to turn the knob and tells you to turn the knob only to have the plant working at 40% instead of 100%, the heat rate will be much worse. The efficiency will be much, much worse. And that's not your fault because that's the off-taker who told you how to turn the knob. And that penalty should be that penalty should not be on your behalf because that's the whole business of why you, oh God, the whole reason for having a capacity payment and availability based project is that you don't take the risks of the off-taker telling you how much to run the plant. So here's an example. This is a heat rate degradation, and this is what happens to the generation as it goes down. Now, after you do that, you fix it. So you actually have to put a target heat rate that's different and assume some maintenance, some major maintenance. You notice that this is not starting at zero. This is supposed to show you how the best way to have the heat rate is you have the most efficient when you're operating at full capacity, least, so you have a different heat rate depending on how much you run the plant. There can be some very nuanced and very, very interesting arguments about these target heat rates. If the power plant sets a heat rate that's not equal and tries to make a little profit off of the heat rate, it can really distort the dispatch and the overall economic efficiency to society. For example, if the true heat rate is much worse than what you bid, but on the other hand, you bid lower capacity price. I hope I said that right. Then you're going to dispatch the plant more, but that's going to mean overall for all the plants in the system, they're going to be buying too much. They're going to be buying for a less efficient plant than a more efficient plant. These are all fascinating little questions. The nuanced ones are really good, kind of nice. Enough of the heat rate. This shows you how you have to, when you actually have this PPA agreement, there has to be some kind of appendix where you put the actual hour by hour heat rate, and then you have to have somebody go and check it all, and you put the heat rate separately from the cost of the gas, and then you get your whole fuel payment for this. You got to do it hour by hour, and then not only that, you might have to, yes, you have to put if you're operating a lower capacity or higher capacity, what kind of heat rate you're going to get. And this is with different years, you got to put a different heat rate in. Oh my gosh. Okay, and this is if you now there are these projects that have you can call it an energy conversion agreement, where they're basically the same. The government says, or the off-taker says, we're going to rent the plant from you. We're going to supply fuel to you. I'm going to buy the fuel. I don't want you to buy the fuel. I'm going to put it in your plant. I'm going to give you a rental payment, and then I'm going to get the electricity at the end. You still, and if you have O&M, you have to pay for that. You still, in that case, want the government. You still want the investor to take the risk of the plant being less efficient. You have to put the same kind, then you have to write in this contract a separate kind of penalty to do it. And here's some more craziness of the heat rate being adjusted by the temperature. And here I've got another, back to our Christopher Columbus project. In this case, there was no heat rate penalty or anything like that. The net electrical energy, having read the billing meters, here we're going to pay you the average charge in such a month invoice. So you got to pay your direct costs. Okay, no incentives whatsoever. That's the one with the 19.37 capacity charge. That's my little tiny little case study. Okay, now once we, of course, I say, God, I gotta stop saying it. Once we have the risks all defined, then between the off-taker, the person buying the power, and the person, the investor selling it, then you go and sign different contracts. And this whole business of back-to-back contracts. Once you, and here's, I think, how you, no, well, whatever. I don't know if I really believe this. If you really kind of do this, you could write the PPA contract. That's where it all starts. That was my complaint in part one, that in part one, that you got to start with where the money's coming in. That's why I made this big red line. That should be green maybe, because that's where the money's coming in. And oh, maybe euro's red or something. Okay, then there are some penalties in this one, and if there's a penalty for the heat rate, you better make sure the O&M contract, or somebody, you could even get a heat rate guarantee sometimes, you better make sure that that penalty, the O&M contractor gets penalized for that, because the O&M contract controls how much maintenance you do, and that maintenance determines whether the heat rate will be okay. And it could be one for one. And then this PPA contract, it could have a liquidated damage for delay, and that liquidated damage should be almost word for word the same as in the EPC contract. And that's what the lawyers are all very proud of doing and saying when they talk about back-to-back contracts, but it all comes from this first contract. You can call this the project contract or something else. Same with fuel supply. All right. That's that. And then here's a thing from Fitch where they say once we have all of the capacity charges defined and everything else, our risks are associated with heat rate, O&M, and availability. Now, this is kind of idiotic. It's not idiotic. That's how they do the stress case and say, see what the DSCR is. If we when you increase the heat rate because it's backwards, it's not really efficiency. You decrease the efficiency by 5%. What happens to the DSCR? Can we still pay off the loan? Okay. What happens if we decrease the availability percent by 10%, which they do for all different kind of projects, or increase the O&M expense? This looks pretty arbitrary to me, but it illustrates what the costs are. Okay. Now, I think this is about the same one as the other one. We're going to talk about a case study in a minute. If you're really reviewing these projects, I'm going to get to the off-taker problem. If you see something like this, and maybe the near 1 billion transaction, which was this, sorry about this. This is scheduled. This is the 350 megawatt combined cycle, and it cost 1 billion. That's enormous. And you've got to understand, where does this 1 billion, why is this 1 billion when other people could do it for about 350 million? And you can say, we've got risks in Africa. We've got additional EPC risks. Now, before you start adding, there's no question, by the way, if an EPC contractor has a fixed price, they're taking risks, and we're going to talk about them more again. Okay, they're taking risks. But the question is, and they're taking risks of cost overruns and everything else, and they would have to go through some, if they did it really correctly, some real careful assessment of how much risk are we taking from a cost plus versus a fixed price contract. What's the chance of a overrun, and where are the sources for an overrun, and what do we get compensated and what we don't, and how much extra do we have to charge for taking that risk, like anything. But then you say, because it's in Ghana, we got to take much more risk. And everybody will say, yes, of course. And then you got to figure out, well, no, go back to what are the sources of risk? Is the supply going up? Is our labor cost going up? Maybe we have more of a chance of a strike of the laborers, something like that. Maybe. But it's not just arbitrarily putting risk, because if the government would stop something in the middle, you could say, no, I'm an EPC contractor. I get paid progress payments. I'm going to stop this right now. Okay. Here's another one. This is 953 for 400. Why does it cost so much? There's all these excuses, I know. We can't get the equipment there, and we got to pay the whatever stuff, extra stuff off. So here's what I'm going to do. This is about the end of this section. This is my favorite case study. Well, yeah, it is. I've talked about it before, I'm sure. And if you have to listen to me again, I'm sorry. This is a combined cycle power plant in, I don't know if Double is the place, but it's near Mumbai. Okay, and I don't know which are the heat recovery units and if the things are here. And it's GE equipment, and they brought the gas in and they stored it in these tanks. And there's Rebecca Mark, who's the representative of the investor, and I assume that's the off-taker. They're both very, very happy. Good. Okay. And this is the case study. Now, I just love, sorry I talk about this too much, but I love this. This is, for me, this says so much about financial education. It says so much about what we indoctrinate people with in their minds. They, at this time, you know, I think Enron was the biggest recruiter from Harvard. I think I really do. I'm not. Their company, Enron Development Company, had headed by Rebecca Markets, youthful and energetic CEO. She's, I'm sure, a nice lady. I'm not saying anything bad about her, please. We're an eclectic bunch of military people. We have a certain amount of here missionary zeal. This is what irritates me. That you go to Harvard and you think you're going to become a missionary. And when you become a missionary, you have to really believe in what you're doing. Okay. And it has three parts. You got to do that. And you really believe you're good for the country, just like our other Christopher Columbus project. And then to get we're going to get the economy moving, and we're going to be environmentally perfect. But third, we're bringing a market mentality and spreading the privatization gospel. Oh my God, I just can't get over that you'd put this in a Harvard Business School case study, and then some Harvard professor would go up and with a straight face saying, ah, look what we're doing. Well, when we make our diagram of this case, somebody else did this for me, this PPA agreement. This was the PPA agreement signed here, signed between, and it was signed between the Maharashtra, sorry about that, State Electricity Board and Double, the SPV. That's who signed it, and then the government of India give it a limited guarantee, government of Maharashtra full guarantee, Ministry of Power, a comfort letter. I don't know what the Reserve Bank of India was doing, is promising that there's going to be USD to get the money out. Okay, and in the from the financial side, there was a political risk guarantee. Here's how I would have made the diagram. This is really pretty good. Maybe this is better. It's more artistic, kind of. I made the contract square and in yellow. And then I put where the sponsors, who are these off takers? And if it's in red, the sponsors, which were Enron, GE, and Bechtel at that time, three of the big US companies, and this was the biggest IPP that had been developed, the independent power producer, I said, as a foreign direct investment. Okay, they were the shareholders. Now, they signed an EPC contract. Well, the first thing was the PPA contract. That's where all the controversy was around, and I tried to put the guarantees. So this is how you might make a diagram of the project. When they signed this EPC contract, well, Enron got a fee, GE sold the equipment, and Bechtel. Now, when you looked at this, the cost was 1,400 USD per kW. We can even use this thing up here that I showed you with our first Christopher Columbus project, okay? And that was that at that time for a combined cycle plant here, this was from another Enron case study, but I remember that time, this was just about right, the cost of a combined cycle project at that time was 500. So you got to ask, do we need this risk premium because we're operating in India? But again, pretend for a moment that the EPC contractor was different than these. Once you finished constructing the plant, and the plant was obviously finished because I have a picture of it there, once you finished, you got your payments. That had nothing to do with the PPA contract, the real risk of the thing from the PPA contract. So why did you have to charge this enormous amount? Now, there was some, to be fair, there was some liquefied fuel facilities, but that was really tricky because Enron wanted to put those in to sell gas to the subcontinent and all that stuff. So I'm trying to be a tiny bit objective. I'm not. Now, right now, if you would make this, if you would make this diagram up here, I put they needed to pay somewhere about 30. I think this is much closer. They need to increase their rates by about 40% to pay for this contract. And if but we should go before we get back to that. Well, let's get back to that in a minute. So then Enron was also the O&M contractor, and here they would have said, I need to make a big, I need a risk premium. And so I'm not going to just charge out the things. I have a fixed price. Of course, you do need a risk premium if you have a fixed price, but how much you really need is the big issue. Okay. Hopefully, if this was a bidded out project, you'd bid this out and you take a reasonable price, a reasonable fee for that. Okay. And then this one, I'm not going to show you. I'm going to tell you this. After you got, without considering getting this, or getting this is another fee. The project IR before the financing, the project IR was something like 22%. Okay, you can measure it all differently and look at it. So that this is a very, very high, if you consider the profit you're making here, and here. The real rate of return, which is the ultimate measure, really in project finance, was much higher. And the Enron got a Deal of the Year award. This is one of these things where it's like the Academy Awards, where you sit at a fancy table and you say, I'm gonna get this big plaque that says I've got the Deal of the Year because I structured these contracts so well, and I got all these lenders to come in. And they actually get the LNG from, I think, Oman and Qatar. And I got this finance because I got all these contracts working, and they're all back-to-back contracts and everything else. So I structured this thing really well, and we should be really proud of you. And then you go up to the podium and say, can I thank my mother? Let me thank my mother. Let me thank my secretary. She worked so well. And we did this as a team and all this. But this statistic makes all these contracts and everything else seem questionable. And the question, this is still debated and fought about for years and years and years. If you did an analysis and you threw away all this and you just say, okay, I'm just going to do an analysis of the off-taker, and I'm going to see what the effect of this project on the off-taker is, and you say, they've got to increase their rates by 39%. Now, what happened when they increased their rates by 39%? Well, there's something called non-technical losses in electricity where people steal it. And if you read in the headlines that Enron you're increasing your rates by 39% to pay for this company called Enron, and here it could have been 40%. This is where I did kind of a little bit of analysis from an India case study. If you did this, then you would say, this doesn't make sense. And the problem is that the economics weren't good. And the problem is we should have benchmarked this cost and see why is this one unreasonable, and spend more time on this than maybe checking all out of the contracts. And this is in Ghana now. We have the same kind of problems where you can't pay all the bills. Okay, and then if you look at, here's what I did. This is old. I wish there was a new one. Maybe there is that I haven't seen. This one goes through projects, electricity projects. There's a power project. Government terminated the project agreement. State, this is our project, didn't refuse to pay. Local government unilaterally paid a tariff that was too low. Government refused to accept the project. Government terminated the project. Where's another power? A downgrade of foreign currency. So that's a little bit different one. This is just downgrade. This isn't defaults. Okay, where's another one? A dispute with government. You can see that all of these risks that we went through, all the PPA agreement, yeah, they affect the IRR equity return of the project, but the real risks are the off-taker risks. Okay, and just to, and then we can look at some other projects. This is where the defaults occurred. This is another Standard & Poor's report. It's so hard. You know, I'm sorry, I have to stand up for Africa sometimes, but here's in Western Europe, here's 42%, only 27, they're good. North America, 21%, much more defaults. Asia, not so good. Africa, 8%, but only, and Middle East, only 3%. Same here. Okay, so why we have to charge so much big risk premiums here, who knows? And then we've got some other statistics. Okay, and I think I'm going to just show you, do one more thing in this case. So if you, again, get the disk that or the Google Drive or whatever that I send, sometimes I put some case studies here, and then I'll put some electric power case studies and a double case study, and you can get so much from just one little thing here. Here, if you go, and so it explains that there's a 200, no, it explains that the whole project cost 2.8 billion. And then up here, it's got the PPA contract, and that's what you really compare about. And this whole PPA contract, the whole thing was designed, so I copied this, and the whole thing's designed so that we can get EBITDA from this. Now, there are all sorts of other little games going on here, but if you copy and paste this, this is what I do with students. Now, you notice that it's not perfect. This is not, just right. And then you go to the disk, and you go, and there's a file called read PDF to Excel. At the bottom it says Shift Control A. You don't have to press this auto open, and then you press Shift Control A, and then you go up here and you say, no, I gotta combine the rows, and then you press Continue. Here, sorry about that. And then it gives you the kind of breakdown. This was a little bit bad, but the big deal here was, anyway, this was the capacity payment. Now, this plant, if you go back to the case, the plant cost up here, the plant costs, see, it's Harvard Business School. The plant cost 2.8 million for 2.8 billion for 2,000 megawatts. So I'm not distorting anything. Okay, so we put up here, let's put another thing here. Shoot. So, well, okay, and then this is our operation period, okay? And then once we do that, I guess, what happens when you do that? this is the shareholder return. This stuff should be divided by 1,000. So you can put 0.001, and then you can put Control C, and then Alt ES M. Okay, and then we can put in our capital cost. Now, it might have really taken them more than 1 year to build. So this is a little bit simple, but we put 2.8, that's million, right? And then let's put another, let's do this in real, so we don't get confused by dividing by 1,000 and all this. And then let's put the megawatt, and the megawatt we'll put as 2,000. Let's put the kilowatts, because this up here is the USD per kilowatt. So we put 2,000 and then another 3. That's the kilowatt. Okay, 2 whatever. Okay, I gotta make this wider. All right, and then once we put in the kilowatts, then we go back to the case study, and we go back to the very end again, and at the very end they had that we run 8,760 hours in a year, okay, and we don't have to do a whole lot of analysis, but just a little. So we put hours, and then we take I'm gonna put this in megawatts. Sorry, 2,000. Do you mind? Shift Control R for, and then we put 8,760. Now, of course, there's nothing, no person, no machine can run every single hour without any maintenance. That's absurd. But we'll use that, and then we'll put MWH here. God knows why they did that, because it's such a crazy assumption. Okay. Uh, okay, and then whoops. I gotta do this by hand because of this stupid thing. Okay, that's how many megawatt hours we have. And then let's go back to the case one more time. And in that case, one more time, if we go back to that, oops, come on. Case one more time, they said that these were in per kilowatt hour. These are cents per kilowatt hour. Okay, it didn't make them clear enough. So the capacity charge, and I'm gonna put that in let's put USD per megawatt hour. How's that? Okay, so what we would have to do, and this is a little bit of electricity, we have to take that capacity payment, let's put it in dollars and multiply it by 100 because it's in cents, and then divide it by 1,000 because it's in hang on, so and then we just 1 second, one second. Shoot, can't believe this. You should take this one, and if it's in cents, divide it by 100 to get it in dollars, and then multiply it by 1,000. I'm really sorry. That's how much you're paying in USD per megawatt hour, and then we can put EBITDA. Now it's not really EBITDA because because you have a whole bunch of other things. You have profits you're making. Not on. I'm not even talking about the profits on the O&M contract and all that, but there can be profits on the fuel, pure fuel expense. Okay, but that's how much we're making, and in EBITDA. Now we don't have to do much analysis again. So if we look at our first few years, we get the payback period is 1, 2, 3, 4, 5. That's pretty good for a 20-year contract, okay? But if we want to then, and this is pre-tax, there'd be taxes and other items. So this is just, just to get going. And then you'd put pre-tax cash flow. We take our EBITDA and we subtract our capital costs. And just that fast, and then we could put pre-tax IRR. And you can put equal IRR and just look at that. Now, maybe there's something, but 26%. That's enormous. And that doesn't include all the EPC and all that other contracts. So here's my final lesson. I think you should look carefully at that project IRR. If it's really high, you say, oh my gosh, can the government really pay? Or if it's really high in a competitive industry, you say, it's so high, that's ridiculous. Everybody's going to come into the industry and then the IRR is going to be lowered. And that's what happened with all the merchant plants. Okay, and that's enough of that case study and this part of the